So I was here all of yesterday, and I sat down this morning, looked at every one of the panels, and tried to figure out the rhyme and the reason to what was discussed yesterday. And I realized it was the perfect setup for the discussion today. And some of my fellow panelists were not there, but I just took the inventory. We talked about digital assets, spot Bitcoin ETFs, distressed debt, innovation, which we're going to touch upon, the LP-GP relationship, and we're long LPs up here, which is awesome, AI, inclusive capital, and then I missed some of the prior panel, but geopolitical risk was on the agenda yesterday and today too. And every one of these areas affect every decision these folks make. And I use this tagline, it's not easy being an allocator, and I think we're going to prove that a little bit today. They have very difficult jobs. We have a $2.3 trillion of assets represented up on the stage. Norges put us just over the top on that number, but I'm going to start with some introductions, and then we've got a lot to cover in 38 minutes and 57 seconds. So, Carine, I'll start with you.
Okay, so hello everyone, good morning. So I'm the Chief Governance Officer of Norges. Some of you know us as NBIM. We're the Norwegian Sovereign Wealth Fund. So we are probably $1.6 trillion fund, and we set up really to benefit future generations of Norwegian. We are a generation fund, and the whole purpose of the fund is really when Norway found oil and gas. Some smart politicians, bureaucrats thought, okay, we're not going to spend the money all at once. We're actually going to put it in the fund, so we can benefit not just the generation that found the oil, but also future generations. So the fund has then grown over time. And of course, with a big fund, the big decisions are, how do you allocate the fund? What's your allocation decisions? And we're quite peculiar in that way. First of all, the main allocation decisions are decided by the politicians. It's actually decided by the parliament. This sort of thinking behind it is that, the fund is to benefit the Norwegian people. Let the sort of people represented by the parliament decide on big fund decisions, sort of very democratic model in a way. So we're 70% allocated to listed companies and around 27% to fixed income. And then the rest of it is to real estate and renewable energy infrastructure. So compared to many other funds, as you may have noticed then, is we don't have a PE allocation. We may come back to that just for real estate and renewable infrastructure.
Okay. So we're going to come back to that and governance as well throughout the course.
So just quickly, I want to also say that really, the mission of the fund is to create as much long-term returns as we can. But it's within a few caveats, and that's we should manage the fund responsibly, with low risk and with low cost.
Thanks, Carine. Yana?
Hi, thanks so much for having me here. So my name is Yana Kakar, and I'm with CDPQ. For those of you who are not familiar, CDPQ is the pension fund for the people of Quebec. So we manage the money for 6 million grandparents in this province of Quebec in Canada. We're about $330 billion US in size, and we invest across asset classes. So infrastructure, real estate, private equity, public equity, fixed income, you name it. I'm based here in New York, and I'm the head of the Americas. About 40, which means I oversee the capital invested in the Americas, which for a Canadian pension fund is all the areas outside of Canada. So that's about 45% of our invested capital. Our mission at CDPQ, sort of the way that it's encapsulated, the philosophy, is to invest constructive capital. So what that means is CDPQ actually takes very seriously the sort of community obligation that goes along with our fiduciary duty. So we aim to invest, of course, long-term capital, but do so in a way that advances the interests and the economic development of the people of Quebec. That's half of our mandate, as well as drive returns for our pensioners. It's great to be here.
Thanks, Yana. Steve?
Yep. Thank you and good morning, everyone. I feel kind of small on stage all of a sudden, so given the millions of beneficiaries and the dollar amounts here. My name is Steve Meier. I have the privilege of being the Chief Investment Officer for New York City Retirement systems. Actually 5 unique public pension plans that benefit the police, the firefighters, the teachers, the non-pedagogical workers for the Board of Education, and then everyone else that works for the government in the city of New York, including myself. We have about almost 800,000 participants and beneficiaries, and I've been in the role a couple of years. We don't have to work with the politicians necessarily to make investment decisions, but we do have a complexity associated with what we do. We have, as I said, 5 unique public pension plans that we manage, all with their own trustees, all with their own investment policy statements and preferences and risk tolerances and funded ratios. So it makes it interesting and it makes it a lot more fun. But the folks I have the privilege of supporting and servicing and engaging with, they're firefighters, they're police officers, they are teachers, so they're non-investment professionals. So a lot of what we do is try to help them support their decision-making through education and those types of initiatives so they can be aware of the decisions that they're making. I will say the one interesting element, when I first started the job, I had the privilege of going around and meeting with the 5 trustees groups individually. The police officers reminded me that the difference that they had with the other 4 was they all carried guns. And actually one of the officers showed me he had a gun on his ankle just to say that his returns really matter more than everyone else. And so it was all tongue-in-cheek, but I think it was tongue-in-cheek. But
that's the Luca Brazzi approach to asset management, so you better be very careful. Geeta, hopefully you can hear me all the way down there.
Yes.
Well,
Hi, I'm Geeta Kapadia. I'm the Chief Investment Officer at Fordham University, right here in New York City. We are the Jesuit University of New York City. We have approximately 17,000 students in our campuses, with our main campus at Rose Hill in the Bronx and our campus here at Lincoln Center. We have a School of Business, School of Religion, School of Law, School of Drama, and of course our undergraduate colleges at both locations. I've been with Fordham for just about 2 years, probably similar to you, Stephen. And I have the privilege of managing about $1 billion worth of our endowment.
So thanks, Geeta. And I'm going to stay with you, and I want to come back down and talk about approaches to asset allocation. And Mark Anson, who's been in this industry a long time, he's now at the Common Fund. And people think the endowment model was founded by the Ivy Leagues. It was not. It was founded by a grant from the Ford Foundation to the Common Fund, and off we went. I think now, and Mark can correct me on this, the endowment model is 55, 60 years old. There's a lot of efficiency that's now been brought into the private market. So talk about Fordham's approach to asset allocation, and is it the endowment model or something else?
Yeah, I think I have the fortune of coming from the Yale environment. I used to manage the investments at Yale New Haven Health System, which is not part of the Yale Corporation, but is a very close and friendly neighbor down the street. So I think the endowment model, which David Swenson really took to a new level, it's something that we use as a reference, but I think every university every foundation endowment is slightly different. And so although we think of ourselves in the sort of along the lines of the endowment model, there's no way we could recreate what the true endowment model looks at. We don't have that kind of access that places like Yale and Harvard do. We don't have the ability to have sort of first mover advantage the way they do, but we can use some of the tools that they put in place and really popularize to try and adapt to our specific situation. So we are a long-term perpetual pool of capital. We have that in our favor. We're able to hold things for a long time. The idea is that Fordham should exist many, many years beyond any of us here on this stage being around. So to the extent that we can take illiquidity risk, we can lock up our capital. We want to do that, but only when it's worthwhile, only when we're going to make the right amount of return for the level of risk that we're taking on. So given that we are an endowment, we do support our university's operating budget to the tune of 4.5% a year. And so we do have to generate some income. We do have to make sure that we can meet that regardless of whether the markets are up or down. So I would say, Bill, just to answer your question, to sum it up, we do look at the endowment model, we think about it, we probably are more like it than not like it, but we do have to recognize that we have our own set of particular characteristics that we need to really prioritize and put as our first objectives when we set our asset allocation.
And just a quick follow-up, you said 4 or 5% is what they pull out every year?
4.5%, that's right.
Okay, and I think that's the ultimate, the endowment model, which is you're matching the duration of your assets to your liabilities, which makes great sense.
It's a very similar situation to I came from the pension world, so to me, although it's a very different institution, the similarities are they're very close. I mean, you have a spend rate, you've got to meet it. It's the same idea with meeting pension liabilities. The only difference is that we can't close the universe. We don't want to close the university. So unlike a pension plan that can close and freeze to new accruals, we can't do that.
Okay, excellent. So Steve, I think about coming out of 2022, the denominator effect was in the news cycle on a regular basis. And the only way that was possible was strategic asset allocation was in play, and people have to cap up where their buckets and targets were. Are you SAA or something a little bit different? What's your approach?
We're a strategic asset allocation pension plan, but we are evolving. And we're evolving slowly, something that's more holistically oriented. So we just finished a strategic asset allocation for our 5 plans. And what gave rise to that wasn't necessarily 2022, the denominator effect of the backup in base rates. It was really the fact that we had legislative changes in New York State that applied to New York City. It basically increased the amount of money we can now invest in alternative assets or private assets from 25 to 35%. The only area where we really come close to that was private equity. It was a much longer term program at the City of New York. So we're actually in a position now where we're deploying more capital. We've got about $63 billion in alternative assets now, going to $85 billion, hopefully in the next 5 years. Again, through that normal course pacing plan.
And to follow up for you, so Geeta mentioned 4 to 5% draw per year. I think you would probably love to have that intel, but you've got demographics on the back end.
There's a lot
of uncertainty. So how does that factor into your ability to go long from an investment standpoint when the call in your capital is getting shorter and shorter?
Yeah, so we're sort of reevaluating everything we do and how we do it in terms of how we manage and think about liquidity. Again, we've got a strategic asset allocation bias, but I do think there's a different way to look at things. So the strategic asset allocations, a lot of times you run the risk of having very siloed mentality as opposed to something what I refer to as more holistic engagement, where the people that are on the investment teams don't just think about their asset class, they think about their asset class in the context of the broader portfolio. So we're trying to evolve to something that's more thoughtful. To answer your question more directly, though, because we have, even if we're at a 35% allocation on alternatives, we still have a lot of liquidity in the portfolio through our public equity and public fixed income securities. One of the funds is cash flow positive still, the other 4 cash flow negative, but the contributions, it's not really that much of a drain. So we have a 7% actuarially assumed rate of return target, and we're committed to meeting that and beating that hopefully over a long-term horizon.
So hopefully the police are cash flow positive. So Yana, maybe fairly unfairly, if I think of Canada, I think of the Maple model. That may or may not define your approach. How do you think about asset allocation?
Yeah, absolutely. Well, and I think it's worth actually teasing out. There are some very interesting differences on the stage in terms of asset allocation. So, for example, I was thinking as Carine was describing how Norges works with Parliament, our asset allocation, our investment decisions are all independent. So we're managing the money of the Quebec people. However, and the way that it actually works is it's 48 depositors, that's other pension funds and insurance plans, that roll into us and we manage it together. So together with the 48 depositor institutions, we determine asset allocation. And, William was just mentioning the Maple model. So there's, the term is the Maple 8. Now, I think there's actually like 10 of us at this juncture. Yeah. But, maple leaf being, of course, from the Canadian flag. One of the distinctions I think that we have in common across the Maple 8 is we tend to do much more direct investing than is, I think, typical, one could say, of the American pension funds. So, for instance, at CDPQ, we invest 85 to 90% of our capital directly, by which I mean not through a fund manager. And I think it's fair to say that it's more typical in the United States that the allocator will truly just allocate to a manager who will then, be the one managing and deploying the assets. Now, the distinction that I think is worth drawing as you get to know CDPQ vis-a-vis the other Maple 8 is in fact our dual mandate. So I mentioned earlier, we sort of have a twofold objective. Number one, of course, is execute as best we can our fiduciary duty on behalf of our retirees. But second, the other side of that coin, if you will, is to do so in a way that advances economic development and supports Quebec businesses. And we do that in a couple of different ways. One is we are actually amongst the global institutional investors. We invest more capital in our home, if you will, in our home region than any other. So we've got 88 billion Canadian invested in Quebec now, and that goes to 100 billion by 2026. And that really is a remarkable set of capital. And while we don't disclose everything publicly, it's capital that actually is performing extremely well. So it's certainly not at the expense of performance, not at all. But that is something that is distinct to the Quebec pension fund amongst the Canadian pension.
So a quick follow-up for you, Yana. So I didn't realize the percent for direct was as high as it was. All things being equal, I assume that's a tremendous advantage because you can control when you come in, how patient you want to be when you come out.
Yep.
Not worried about a fund or secondary markets.
Absolutely. I mean, I think it's the long duration is such a gift, and it's something that we as investors we take very seriously at CDPQ. And the directness, this is an allocator, if you will, conversation, but really allocating your capital, that's just step number one. What you really want to be able to do is actively manage it and actively engage with your investees. And that's something that we do at CDPQ, entirely. So in infrastructure investing, for example, we will own, we'll operate, we'll be the designer, the investor. It really will be very end to end. And that is, it's definitely a privilege, and I think enables us to drive performance in some really creative ways.
Thanks, Yana. So Carine, maybe for the audience, you almost were not on this panel. If Roar is out here, shout out to him. He was your proxy, because we were talking about allocating to alternatives was the original title to this panel. But you are the Norway model. You are Norway. So your approach to asset allocation, which is exclusively in the public markets.
Yeah, so we're very different, but it's interesting to also listen to some of the similarities, right? Although we don't have a guy with a gun on our board, but there's some similarities here. For instance, we're 95% managed in-house. So even though, we also at our allocator, we also do the management mostly ourselves. But as I said, the big allocation decision is decided by the Minister of Finance with sort of approval from the Parliament. But that doesn't mean, of course, we do a lot of active stuff. Around of the 70% that's invested in listed markets, around 20% of that is active management, and the rest is sort of following an index, which is starting with FTSE Global. And so that means we are very much a diversified investor, but compared to you, we don't invest in Norway. We invest in all other countries except in Norway. But going back to what you asked about alternatives, so we not invest in private equity. And probably all of you may think that's very strange for such a large fund. Everybody else is in private equity. Why aren't we? And yes, we sort of think sort of slightly the same. And the model in Norway is that we as a fund, we can advise the Ministry of Finance of changing the allocations, changing the allocation decisions. So we do that in form of old-fashioned letters back and forth. It's very transparent. Everybody can read the letters. So we've had a long process where we sort of send letters to the Ministry of Finance saying we think it's a good idea to invest in private equity on a sort of risk-return basis. And the Ministry has thought about it, came back and said, well, not now. And then you may think, why did they do that? And what's interesting is if you're allocating, as thinking about sort of broader views than just risk return, other considerations come in that we have to think about as a fund that's owned by the Norwegian people. So it's consideration around transparency, valuation, opaque valuation. Can you get sort of transparency around valuations, large fees? So there's sort of other considerations that taking into account on sort of the big allocation decisions. And that's why they said private equity not now, was sort of wider considerations. And then be an expert group put down, and maybe in the end they'll open up for it. We shall see.
So a follow-up on that, and if I get into an area that you're uncomfortable with, you can just wave me off. But this has been in the press.
Yes.
And
Very public.
1.6 trillion times 5% is $80 billion. So that was a big move. And I think about a Warren Buffett and where he made his money. He made his money for his shareholders when he was a liquidity provider when nobody else was. So interesting that Norway sovereign wealth could have been a price maker. And you talk about this freeze in the PE market, and this is the ultimate direct investment, coming to your point, Yana. So I could see the opportunity set. And do you think this is a decision, well, not today and maybe tomorrow? And maybe you could touch a little bit on governance too, because you're maybe less controlled by a board of directors and more controlled by the sovereign, which is maybe very different from the other panelists.
Yeah, and that's a very different model. As I said, yeah, we are, we can say in a way we have one owner, that's the Ministry of Finance, that decide, the main decisions for the fund, and we report to them. But they get their input from the Finance Committee, the Standing Committee in the Parliament. But also we have 5 million owners, the Norwegian people. And the fund benefit them by the fact that 3% of the fund can be taken out every year, put into the national budget, and that's actually 20 to 25% of the national budget. So if you think about it, every fifth teacher, nurse, doctor is paid by money from the fund. And that's why it needs to be so, like I said, in a way, anchored sort of democratically, the big decision. But all investment decisions are taken arm's length basis. So no politician gets involved with that. So all sort of the daily running of the fund is done independently, and then we have a board we report to for that. So it's sort of, we report to the board, but on big decisions, it's the Minister of Finance.
Okay. So I think a very good sort of tour through various asset allocation models. And I think what I heard is that it's kind of like this, but it's a little bit something else, or it's evolving. And I think that's maybe some of the opportunity and challenges of the seats you sit in. So maybe shifting gears a little bit, Yana, and I know that CDPQ and your colleague Mario have been very involved in LP-GP transparency. Mario is now chairing the Standard Board of Alternative Investments. What is the current state of play between LP and GP relationship? And it may be maybe weird I'm asking you this question because you go direct, but certainly CDPQ has a big interest in this space. So maybe you could talk about that in governance from your standpoint.
Sure. I mean, I think what's interesting is when we're at the size that we're all at, we do a bit of everything, right? So we do an enormous amount of public markets investing, and yes, an enormous amount of alternatives. And I think that it's fair enough to say that the LP-GP kind of paradigm is evolving, and increasingly it's more one of partnership. And I think of sort of partnership and strategic engagement. Typically that phrase has been used more when discussing engaging with a company or an ultimate investee. But, we are, if I think now about, for example, we have a partnership between Natixis in France, 91, a manager out of the UK, and the U.S. Treasury Department, and all of us are looking together at blended finance models and how can you combine public and private sector financing in order to better deploy capital, in order to reach energy transition goals, but also serve the investee. These kinds of partnership conversations, this kind of LP-GP engagement as partners, not just I am the allocator and you are the asset manager, I think increasingly is the norm and increasingly is driving value and return.
And Steve, I want to ask you what percentage of time you spend on governance and LP-GP relationships. I assume it's a lot, but your relationship is probably very different than maybe everybody else up here with the 5 plans and 5 different boards of directors. And maybe with you, I'll start with governance. And this was covered yesterday about maybe more common sense legislation. And I'm from Massachusetts. I won't name the name, but one of my senators is anti anything having to do with the private markets. But when I really think about trying to up the educational ante, I think about the boards. The investment committee can be very sophisticated, but if the board of directors is uncomfortable about allocating to alternatives or allocating to spot Bitcoin ETF or digital assets, it becomes a bit of a problem for you.
Yeah. Well, I actually to echo some of the sentiments that raised earlier. Certainly, we're very aware of fees that we pay, and we're actually developing internal analytics that try to determine alpha generated per unit of fee, as well as risk. So we're trying to get a sense for what that dynamic looks like. Again, we're 5 public plans. There's a lot of folks that look at us through different lenses. So we want to be very smart about making sure we're getting good relative value for the fees we pay, irrespective of whether that's in private or public markets. I do think Yana made some really good points also about just the partnership. So when we think about private assets, we don't think these are markets you lean in and out of. So we like to be a core commitment. We like to be a core source of funding. We think that the current environment and our position and how we actually work with our GPs through LPACs and other types of arrangements puts us in a good position to have the best access to the best managers out there. We're also very proactive in terms of negotiating down fees. I think we do an excellent job negotiating fees. I think we do a poor job communicating that to our boards of trustees. So we're looking to improve on that. And I'd say just co-investment in the partnerships that you talked about. That's a big driver of performance for us because we're able to average down fees and carry effectively.
And so Geeta, maybe finishing this part about LPGP transparency, it seems like a lot of the returns in the private market, particularly PE, are driven by financial engineering, NAV-based lows as an example, as opposed to good old-fashioned investing at this percentage of EBITDA and getting a higher EBITDA and a higher turn on that when you exit. Continuation funds have been talked about as well. I know there's organizations like ILPA that try to unionize folks like you to say, hey, GP, we're going to write the rules of engagement, but it doesn't always seem to work out that way. So from your vantage point, maybe in this current cycle with this nuclear winter, perhaps in PE, how is transparency between LP and GP working?
Yeah, I mean, we really look to allocators such as these 3 right here to try and help us. You know, we want to be part of that conversation. We recognize that we don't have the leverage to be able to move the needle, but we hope in a similar way to the way you put it, you know, if we club together as a group and really demand transparency, demand more alignment on fees, more understanding of where those fees go, we have a lot of power. And so I think it's been a very disparate conversation, unfortunately, but we really need to kind of come together because regardless of who our underlying stakeholders are, we all want the same thing and it's all going to benefit all of us and by extension, our stakeholders. So, you know, when I think about spending money on fees to make another, sorry for any managers in the room, another, you know, venture capitalist richer and buy a 3rd yacht, like that doesn't feel good to me. So, you know, every dollar that I spend on anything is a dollar that I'm not giving to a student who needs a scholarship. So for us, it's a very visceral and a very personal thing. We're very committed to it, just like everyone is here, because it's important to us. It's why we do this job. And so for us, having that conversation is one we try and have right up front. And that's really why we end up partnering with smaller shops because they're more willing to have that conversation. Ironically, they're the ones I feel good about paying fees because they're really not the ones who are buying their, you know, second townhouse in London or something like that. But we really want to try and make sure that the fees are appropriate for what we're doing and also that we understand we're all in it together. We want the same thing. We want you to outperform. That helps us. It helps you. So we're all need to be rowing in the same direction, and having that transparency and those conversations up front to us are really key.
And really interesting issues as well, because we 95% of the folks we support and service are union employees.
Exactly.
And I have to say, if you ask me what was the thing, and I don't mean this disrespectfully to anyone, the one thing that's really surprised me in the last 2 years, I've never met as many billionaires in my life. I never thought I would.
Yeah.
And there's got to be some information value in there. You've got extraordinarily talented people that were hardworking and in the right spot at the right time. Also, maybe we're overpaying in fees. You have to ask the question, and you need to try to get back to first principles. How can we quantify the returns that we're getting relative to the fees we're paying?
Yeah, no, very good points. And I know we have some emerging managers at this conference, and I think they've got it in a very, very tough spot. And Ashby Monk, who you probably all know, he writes a lot, a very thoughtful, very clever guy. And one of his famous lines was, the only way you get fired from an endowment is by innovating. This career risk by hiring an emerging manager. So so I think understanding each other's pain points is critically important. So great points. So shifting gears, Carine, and starting back with you, I ticked off a list of all the things discussed yesterday, and you were probably squirming in your seat saying, where the hell is climate? It was not really covered yesterday. Now, maybe I missed one of the sessions, but there was no session dedicated to climate. And I'm not sure if there's one dedicated to climate today, but it is a big part of what you do. And the fact that you have massive positions in public companies, you can be a very big voter at the proxy window. So to talk about how important that is, not only to Norway, but from your vantage point, the world. And maybe if Anthony's listening, we can get this on day one next year.
Yes, it's about time that we talk about climate. And as I said, our mission is to create long-term returns. That's it. But what we thoroughly believe is that our long-term returns will really depend on an orderly transition towards the goals of the Paris Agreement. So that's basically net zero 2050. And we've done tons of scenario analysis that really shows the value of the fund is best preserved by an orderly transition, and that's how we think about it. And so for us, really, we have as a part of our mandate that we shall work for the companies in our portfolio to reach net zero at the latest by 2050. So on the back of that, we have set up a climate action plan that really specifies in detail how we are going to work with that, how we're going to be a force that sort of drive companies to set targets and to work towards reducing emissions. And we do that from a financial perspective, because really, what we think it's about future-proofing the business model of the companies you are invested in. Because if the world is going down towards less carbon emissions, how are these companies going to be valid if they don't think about their strategy and how they're going to reduce their emissions? So we do that mainly through, we talk to companies through dialogue and also through voting. And just to show a bit the sheer scale of it, like last year we had more than 3,000 company meetings. And in one of more than 2/3 of these meetings, we talked to companies about climate. We started talking about target setting, but then we've quickly moved on to also transition plans. So that's basically the actions for how you're going to reach your targets. So that's a big part of the work we do, really to work with companies, so getting there. And what we always say is that we want to be an owner in the transition. We want to make money from the transition. We see both the risk and the opportunities. But we also say, in some instances, we divest. If we see there's sort of we get nowhere with the dialogues we have with the companies. But basically, our goal is to be owning the companies through the transition, support the companies, and make money on it, and then get a more resilient portfolio at the end.
Well, you wield a very heavy hammer, so keep on keeping on. So, Yana, I would assume, given your direct investment quotient, you can have very patient capital. Seems to be a perfect storm to maybe really think about climate and other risks as the ultimate double bottom line. Does that factor into your thesis?
Yeah, look, let's just be frank. The transformation of the global economy, the decarbonization of the global economy is already well underway. We've got 75% of our capital invested outside of Canada across 70 countries. This is the opportunity that climate investment represents is why the conversation should matter to investors. And I think changing the conversation and shifting it from climate is a risk to be mitigated or managed, that's certainly true, to this represents a series of investment opportunities and the smart investor should be looking very seriously at them, is a shift in conversation that we've already had at CDPQ and we hope others will begin to have. Just to put things into scale perspective, energy transition, investments in energy transition represents $6.5 trillion economic opportunity per year from now through 2050, they estimate. So that amounts to a couple $100 trillion? The entire GDP of the world is $100 trillion. So even if the private investor executes on 20% of that, that is an enormous economic opportunity. So I think at CDPQ, when we look at climate investing, when we talk about climate, yes, we look at it from the risk management perspective, but we look at it very much from a where is smart money going, given that we are already underway in a fundamental transformation and decarbonization across the globe.
And Steve, part of your IPS climate, or is it manager dependent?
We definitely focus on climate as one of the key themes. So we're not a thematic investor per se, but there are a number of themes that actually inform your decisions in terms of how you position out for the next 10 years, such as demographic shifts and the impact on labor and spending patterns, deglobalization and the impact on inflation, climate change, decarbonization is huge, I agree. Other things in terms of debt sustainability at the sovereign level, and all these things with a wonderful overlay of geopolitical risks on top. We do certainly focus on opportunities in the energy transition. Listen, we are a fossil fuels-based economy and society. The transition is going to take a lot longer and is taking longer than it should. And from an investor standpoint, I'm more concerned about what's priced in and what's not priced in. And it's interesting to me, too, that just fundamentally we still have differences of opinion as to whether climate change is real or not. You've got different ways of thinking about it in terms of the red state, the blue state debates, which I don't think are healthy.
So, Geeta, I'm going to give you the final word. We have a minute and a half. But so one of the things I love about SALT is they talk about inclusive capitalism on the stage. But then my buddy Troy Prince, I don't know if he's in the audience, but he's got about 8 students. Are any of the students here in the room? If you are, raise your hand. I don't know if they're, yeah, so see some of these hands up. So these are rising sophomores and juniors in college. Wall Street Bound is trying to get more diversity into this industry, not by fiat, but by education. So if you see these hands, I would encourage you to go and meet some of these students. But Geeta, Fordham takes 10 basis points. And it's funny that SWIB was in the news about a 10 basis point allocation to spot Bitcoin. You give $1 million to the students to invest and actually walk in your shoes. I think it's awesome. So you could talk about climate, but inclusive capitalism, I know, is part of how you roll too, and is so very important.
Yeah, absolutely. We want to give students the opportunity to put their money where their mouth is. As you can imagine, over the past couple of weeks, we've had lots of students tell us how we should be investing our endowment. And so we actually have a program that's been in place for over 20 years, that allows them to do just that. We're not the only university that does it. Wisconsin, probably the most well-known student fund. But not only that, but to bring it back to this conversation, we just approved another $1 million to go to students to run an environmental, social, and governance fund. So we hope that they will take climate into consideration. I would be surprised if they didn't, as they start to deploy assets into that fund this fall.
Outstanding. Well, what 1 second. I think General Milley stole some of our time, but he's got more stars than I do, and he may carry a bazooka, not a gun, so I'm not going to call him out. Please join me in thanking the panel.